Welcome back to AS Gold. This is your gold outlook for the trading week beginning Monday, June 8, 2026. Gold has just printed its lowest level of the year, and the week ahead is dominated by one number, Wednesday's U.S. inflation report. Over the next few minutes we'll break down the price action, the macro backdrop, the economic calendar, the geopolitical risks, the key technical levels, and 3 clear scenarios for the week. Let's get into it. Let's start with where we stand. Gold closed Friday near $4,366 an ounce. That's its weakest level since March, and the lowest of 2026. It capped a brutal week, down about 4%, and the metal is now roughly 19% below its January record peak of $5,598. But step back, gold is still up around 30% over the past year. Our verdict for the week is bearish to neutral in the short term, but constructive underneath. The 4,370 level is the line in the sand. Here's the picture on the chart. You can see the steady slide through May, from around $4,565 down to Friday's close. Price is now sitting right on the most important shelf on the board, the 4,370 to 400 zone, shaded here in red. Below that, the next stops are 4,200, then a deeper structural floor near 4,100. Overhead, the first ceiling is 4,509, with the 21-day average up near 4,580. Momentum is pointing down, but we are not yet oversold. So what drove the sell-off? 3 things. First, and biggest, Friday's jobs report. The U.S. economy added 172,000 jobs in May, more than double the 85,000 expected, with unemployment steady at 4.3%. A hot labor market revived bets that the Fed could actually hike later this year, lifting the dollar and real yields, both direct headwinds for gold. Second, sticky inflation. April CPI ran at 3.8%, near double the Fed's target. And third, only a partial safe haven offset from the Middle East kept the drop from getting worse. Let's put the macro backdrop on one screen. The Fed funds rate sits at 3.5 to 3.75%, held for a third straight meeting. After Friday's jobs shock, the market is leaning toward a possible hike later in the year, a clear negative for non-yielding gold. The dollar is firm, real yields are elevated, and that combination is the dominant force pressing on price right now. The June 17th FOMC is expected to be a hold, but the dot plot and the tone are what will matter most for gold. Now the calendar, and this is a front-loaded, high-impact week. The main event is Wednesday, June 10th, May CPI at 8:30 a.m. Eastern. A hot print pushes hike bets higher, lifts the dollar, and sends gold lower. A cool print triggers a relief rally. Then Thursday brings the May PPI and weekly jobless claims, which confirm or deny that inflation signal. Remember, Friday's payrolls already printed hot, and the next Fed decision lands the following week. Bottom line, size down into Wednesday's number. It is the single biggest catalyst on the board. But here's why you shouldn't blindly chase this lower. Underneath the price, demand is exceptionally strong. Central banks bought 244 tons of gold in the first quarter alone, above the 5-year average, and they're expected to keep buying around 190 tons every quarter this year, led by China, India, and Poland. Total gold demand hit a record 1,231 tons in the first quarter. ETF inflows are returning, and any softening in the dollar lowers the cost for overseas buyers. This is the deep bid that keeps absorbing every dip. Then there's geopolitics, currently the main floor under the market. The U.S. brokered Israel-Lebanon ceasefire was rejected by Hezbollah, and an Israeli soldier was killed on the very first day of the truce. Fighting continues. Meanwhile, U.S. Iran talks have stalled, with Tehran reporting no tangible progress and tying any deal to a Lebanon ceasefire. For gold, this is a two-way, binary risk. A diplomatic breakthrough would knock price lower, but any escalation sends it sharply higher. Watch the weekend headlines, a gap on Monday's open is a real possibility. Let's talk levels. On the downside, the line in the sand is 4,370 to 400, the most vital support, and it's being tested right now. Lose it on a daily close, and the path opens to 4,254, then 4,200, and potentially 4,100. On the upside, first resistance is 4,509, then the supply cluster from 4576 up to 4660. The 200-day average sits near 4,429. RSI is around 42, bearish, but with room before oversold. So here are three scenarios for the week. Scenario 1, the bearish base case, around 45%, a hot CPI breaks 4,370 and opens 4,200, then 4,100. Scenario 2, a choppy range, about 35%, an inline print keeps gold whipsawing between 4,300 and 4,510. And scenario 3, the bullish case, around 20%, a cool CPI or a Middle East escalation reclaims 4,509 and targets 4,660. Trade the reaction, not the prediction. To wrap up, here's the game plan. Net stance, bearish to neutral into the inflation data, but respect that deep structural bid. Don't short blindly when central banks are soaking up supply. The 4,370 to 400 band is your pivot. Hold it, and we range and build a base. Lose it decisively, and momentum carries us toward 4,200. Manage your risk into Wednesday's CPI, the biggest catalyst of the week, and watch the weekend for geopolitical gaps. Patience and position sizing win weeks like this. That's your gold outlook for the week of June 8th. If this breakdown helped, hit like and subscribe to AS Gold for daily and weekly analysis. A quick but important reminder, this is research and education, not financial advice. Always do your own research and manage your risk. Trade safe, and I'll see you in the next one.